Thank you for joining us. The following presentation is from a webinar titled Sales and Use Tax, A Different Approach, originally produced on June 25th, 2015. The presenters are Jason Skrinak and Michael Levy, both from McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for more information about our future events and upcoming webinars.
Good afternoon, everyone. Thank you for joining us this afternoon to go over a Sales and Use Tax, a Different Approach webinar being presented today by myself and Mike Eby. I'll give you a little brief introduction about myself. My name is Jason Skrinak. I'm a principal here with McKonly Asbury. I've been doing state and local tax work about 20 years. I always have to go back and check my math on that because it doesn't seem possible that I've been doing this long, but it keeps coming up the same number. I worked with a Big Four accounting firm for about 12 years and been with McKonly Asbury coming up on 8 years now. In addition to McKonly Asbury, I'm heavily involved in Pennsylvania Institute of CPAs, a former chair of the State Tax Committee, member of the Fiscal Responsibility Task Force, the State Tax Legislative Committee, and I have presented and testified before various legislative boards with Pennsylvania. I'd also like to introduce Mike Eby.
Thanks, Jason. I appreciate it. I've had the pleasure of working with Jason for the last 7 to 8 years, pretty heavily in our state and local tax practice. I also have the opportunity to also work with a number of our middle market clients in compliance and tax planning on the federal side. And it's really nice to bring those two pieces together because federal, obviously, a lot of things that are implemented there flow through to the state and local and affect those as well. So I think we're going to then now dive into the agenda. And if we go to what we want to present today, we're talking about 5 main topics. And really, we're going to start with why is it really important to know about sales and use tax? And then we're going to go into some basics with sales and use tax in order to kind of lay some of the groundwork for what we'll be discussing today in further detail. We're going to talk about audits, but if there's really no way to prevent an audit, they tend to be random, and eventually you're going to get one. But if you don't have a good working knowledge of the basics, that's a good way to get a red flag to the state and actually cause an audit. So if we can get those basics down, we can at least avoid that type of audits occurring. And then we'll talk about if you find yourself in an audit or if you're receiving some correspondence from the states that look like they are prying for information. Well, they probably are, and that's not something that you want to disregard or not pay much attention to. That's a good way to get a very large assessment from the state when you're really not doing much in the state, and we'll talk a little more detail on that. And then from there, we'll kind of take a step back and talk about some of the best practices we've seen across a number of industries that we worked with and a number of different taxpayers. We hope that some of the tips we provide will make your business a little more proactive in dealing with a potential audit that could occur down the road. And lastly, Jason and I, this is probably our favorite part, is the refund opportunities that exist potentially for sales and use tax. We're going to share a lot of our tricks in the bag here with the types of transactions we look for when we do a sales tax review, and perhaps you may discover that your business may have some potential refund opportunities out there that you might not have originally thought about.
We're just going to give you some of the tricks, not all of them, or else we'd be out of business. I also just want to throw out there that we're going to have a primary focus on Pennsylvania, but a lot of our suggestions, comments, issues addressed can be used for any numerous states out there. So just kind of caution that this is specifically for PA, but this can be used just about anywhere.
So why is sales and use tax important? Across the country, it's usually the number one heavily audited item by states. It's one of the easiest ones for them to go in and audit. There's a lot of different rules with sales and use tax, so it's easy to find no matter what type of taxpayer. They're most likely to find some type of deficiency.
Yeah, you're going to see confusion out there because that's where they normally end up finding tax liabilities, is when a taxpayer is confused. And it can be easily found through sales and use tax statutes, regulations, court cases. Any unwary eye can kind of get tripped up with regards to sales and use tax. Another thing with regards to sales and use tax, that combined with personal income tax are usually the driving forces behind a state's revenue streams. So those are the two main money drivers that you'll see is personal and sales and use tax.
Yeah, along those lines, sales and use tax is pretty consistent revenue stream. Corporate income tax, from both on the taxpayer level and the state level, you're talking 2008, 2009, corporate income tax became a lot less significant for a lot of states as a lot of companies are experiencing NOLs. Spending didn't take as much of a big hit. Sales and use tax was a much easier thing for them to go after, or otherwise they were just going to adjust a bunch of NOLs on corporate income tax returns. That's
a great point. And another item I just want to throw out there is just to make sure that everyone out there is aware that the states, all states, not just Pennsylvania, are having budgetary issues, and they're looking to increase revenues as much as possible. One thing that we're going to discuss in a little bit is Pennsylvania is actually trying to increase enforcement for sales and use tax, and they are starting with a new program in which they are going to be starting desk audits. That's going to be handled by their pass-through division. So just a word to the wise out there.
Yeah, and moving on to the second point, unlike income tax and some other tax types that could get audited, really if you then get assessed, you're pretty much paying a tax you probably would have paid originally. The real danger with sales tax, especially not really use tax, but sales tax in particular, is that this is a tax that your customers would be paying, and not you. But if you get audited, the state's got you, and they're going to assess you for it. And that's, you're going from perhaps a 10% profit margin on some of your products down to a 3 or 4%, or even worse if you figure in penalties and interest. That can be quite damaging to your business operations.
Definitely, yeah. And like Mike said, the tax is imposed upon the end user, but it doesn't matter to the state. If they come in and they catch you making sales in which tax should have been imposed, they're going to ding you up on that. I've actually had clients numerous times ask me, well, I'll just go back and ask my customer to pay that tax. I have never seen that work. If they reach out to you and say, hey, I just got audited, based upon the sale I made to you, they're charging me 6% tax. Can you pay that? I've never seen someone, oh, sure, yeah, let me open up my checkbook, send it to you. So just a little hint there. If it's taxable, let the individual that's making the original purchase pay the tax on that.
Exactly, and most customers expect it to pay that anyway, so it's not a really something they would figure in necessarily to their to the purchase price on their end. The next item is I think one that people kind of forget about because there's not necessarily a dollar amount associated with it, but there's a lot of other issues potentially associated with it. Sales and use tax, sales tax especially, along with employer withholding, are trust fund taxes, meaning that corporate officers are responsible parties for collecting this. And when you're talking about larger companies, a lot of the corporate officers don't really have involvement in sales and use tax, so they're being held responsible personally for something that they don't really necessarily oversee. And this is one, when we go to Board of Finance and Revenue over the years, we see cases all the time where a corporate officer might have left the company 10 years ago. He didn't get his name off one of the registrations, or his name's still listed with the Department of State as a responsible party. And they're being personally held accountable for some of the delinquencies that the company might be having. And that's obviously not something you want to deal with 10 years after leaving a company. So make sure as a corporate officer, if you're exiting a company, that these things are taken care of. Another horror story was a few years ago. A CEO of one of the large companies in this area, one of his small divisions in another state was not properly remitting sales tax, and I guess they were ignoring notices when they came. So a Department of Revenue agent from that state actually showed up at this CEO's house while he was hosting a party. So needless to say, the dollar amount was probably not even that large, but it was probably a very embarrassing moment for him. And I'm sure whoever was responsible for that sales tax heard about that, but don't let that happen to you. And then the last point, if your company's not taking advantage of all the possible exemptions and exclusions. I'm thinking more on the purchase side. For instance, a manufacturer, if they're not taking the full advantage of what everything the manufacturing exemption allows, and maybe even some beyond it, depending on how far you want to take that, and your competitor is, you're going to be at a major disadvantage in terms of your pricing of the product because your cost is going to be a little higher.
One thing that we're always seeing, too, is when actually just a recent hearing at the Board of Finance and Revenue, an individual got audited, was assessed tax on their sales. However, their point was that they were at a competitive disadvantage because their competitors weren't charging tax. But that's not an excuse. Pennsylvania, the Board of Finance and Revenue, the board members actually made it a point to let them know that if you have an issue with your competitors not paying tax, that's something you can bring to the Department of Revenue's attention. They stated that that's how a lot of these audits are started, is when a competitor feels that they're being slighted, that they're at a competitive disadvantage because they're charging tax or they have been assessed sales and use tax on their sales and their competitors aren't charging the tax. That's a 6% profit margin that, it could swing a lot of business one way or the other.
Right, and we hear that argument a lot made by taxpayers. Well, so-and-so is not doing it, and Department of Revenue, Board of Finance and Revenue, none of them excuse that. It's if it's rightfully owed, they're going to collect it, and it doesn't necessarily matter what your competitors do. But it's kind of a good segue to our next topic in the basics, because as we said before, if you're not properly adhering to the basics, that could lead to an audit. And most audits, they could be generated by a customer reporting something to the Department of Revenue. It oftentimes is a competitor, like we said, as Jason's the situation. But more often than not, it's an auditor reviewing one of your customers' purchases. They see an invoice that's not correctly done from your company. All of a sudden, they're going to send that to a database and flag that, and the Department of Revenue will consider if they want to pursue potentially an audit. So that's why you take care of the basics on your end. That will help mitigate some of the possibility of having an audit.
Great point. So the next slide you'll see is the basics of sales tax. Like I said before, we're going to focus on Pennsylvania, but these same basics can be used just about any state. Once you determine that you're liable for Pennsylvania sales and use tax, first thing you should do is properly register to collect the sales and use tax in the jurisdictions in which you're doing business. For Pennsylvania, that would be filling out a PA Form 100. Once you fill that form out, you get a Pennsylvania sales and use tax license number and a license certificate that you display at each of one of your business locations. I'm sorry, I got sidetracked there. I'm just looking. The one thing you want to make sure of is when you're talking about sales and use tax, it's not just properly collecting the tax. I should have brought this up a little bit ago, but it's also remitting the tax. That's a big no-no. When you're collecting the tax from your customer and you're not remitting it to the state, that is number one basic. Make sure you're remitting the cash to the state, or else you're facing potential criminal charges from the various states. So for Pennsylvania, the next, or any other state, is properly documenting sales to customers. For Pennsylvania and some other states, you cannot include the sales tax in the purchase price. I see it all the time. I've actually had some friends run some small businesses in which I told them, you can't just include the sales tax and back it out and remit it to Pennsylvania. They didn't like to hear that, but one of their customers was actually a Pennsylvania Department of Revenue employee. Let them know that they were doing it wrong, and they actually had an audit commence. So unfortunately, I was right in that circumstances, and my friend paid for it. But most times you're not supposed to be including sales tax in the price sold. One example of where it's okay is for vending machines. When you're selling something out of a vending machine, tax is pretty much included there.
Isn't it funny how our clients will listen to us, but our friends and family often don't, Jason?
Great point. And then ensure the proper state's tax rate is collected. You'll see throughout throughout the country, not only just in PA, but throughout the country, you have a state tax rate, but a lot of folks don't take into consideration the local tax rate. Here in Pennsylvania, you have a 6% tax. If you go buy the same thing in Pittsburgh, you have a 7% tax. You decide to go to Philadelphia and buy the same thing, you have an 8% tax rate. So each locality may have a different tax rate, and you should be very aware of where you're doing business, where you're making sales, and what tax rate should be collected.
And another thing along those lines, vendors sometimes will charge based on where your customer headquarters are located, and the shipping address might be clearly on the invoice to a different state, but forever whatever they put in their system, they're charging Maryland sales tax, and really it's being shipped to Pennsylvania. That's a dead ringer for an auditor, so that is another thing that you want to make sure of.
Definitely. We have a point here, a bullet point about, make sure you understand the filing frequencies with regards to when the sales and use tax is due. It could be annually, semi-annually, quarterly, monthly, or even twice a month. Pennsylvania specifically has a vendor discount. It's a 1% vendor discount based upon submitting and remitting the tax collected to Pennsylvania in a timely fashion. There's no limit to that amount. The last couple budgets have gone by, and they've discussed having a set limit as to what the vendor discount could be. They're actually talking about, I think it was about $250, $300 annually, in which that discount was limited to. Some of the big retailers had a big problem with that because they were getting a nice chunk of change on this discount. So that's something to keep your eyes open on. Another thing with regards to reporting sales tax, for Pennsylvania, if you are in the business of purchasing items and using some of the items and selling some of the items for resale, you may have items that you purchased, you paid the tax on, your intent was to use that within your own organization. However, if you decide that you're going to go out and resell it, you actually paid the tax up front. When you resell it, you should be collecting the sales tax again. So in essence, Pennsylvania got tax on that transaction twice. They got it when you first bought it, and they also got a second tax when you sold it. On the Pennsylvania return, there's actually a line item in which you can claim taxes paid, property resold. So that's one area that I throw out there all the time just to make sure people are aware of it and using it. It's one of the few areas in which you can get resolution to an issue for Pennsylvania sales and use tax without having to go through the administrative appeals process. The next slide, I'm going to really breeze through this one, is basically just Pennsylvania's filing frequencies. You'll see here that there's basically we don't get involved in anything other than monthly filings, because for monthly filings you have a sales tax liability between $600 to $25,000 a quarter, and that's kind of normally where we see our clients coming in. There is also a prepayment amount for amounts over $25,000. That was brought into statute a couple years ago. The only reason they really brought that in was to get a one-time hit of revenue. After that one-time hit, it kind of evened itself out. But if anyone has any questions or concerns about your filing frequency or that prepayment issue, please feel free to reach out to one of us. We'll provide our contact information at the end. One thing I definitely want to throw out there is to make sure that anyone having any payments being made to Pennsylvania in excess of $1,000, these have to be made electronically. For sales and use tax, it can be made through the eTide system. Everyone I've talked to that uses eTides, they find it extremely easy and no hassles. But anything over $1,000 has to be made electronically. The payment has to be made electronically, or you subject yourself to a possible penalty.
And continuing on to the basics, we'll move on to use tax now. And kind of get a brief definition of what use tax is. If we compare it to sales tax, the responsibility to collect that is on the seller. Use tax is the responsibility to remit that is on the purchaser, the purchaser. Yes. Typically, where you run into a situation where use or sales tax is not collected on a taxable item and use tax is due, it tends to be an out-of-state vendor that doesn't have registration in the state. Whether that's right or wrong on their part, it ultimately will fall to the purchaser to remit that use tax. Internet purchases are a big thing because a lot of internet vendors do not have sufficient nexus, which is the requirement to file in a state. They don't have sufficient nexus in the state that they are selling into. So that's something to be on the watch out for.
And a lot of people don't really understand the whole concept of use tax. I've had professionals in the past that I've been friends with talk to me about, oh my gosh, I got such a great deal on furniture. I bought it down in North Carolina. They shipped it up to me. It was about 10% less than what I would pay for it up here. And I asked them, I said, did you pay PA use tax on that? And they're like, no. I'm like, well, that's probably why you got such a great deal on it. So if you're buying something out of state and using it here within Pennsylvania and it's taxable, you should be self-remitting use tax.
Yep, and like Jason said, it's always been an issue, but it's not been as prominent until the internet sales have become such a commonplace right now. Most people weren't driving all the way to Delaware to save 6%, but if you can pick up go on the computer and click a few buttons and save 6%, in your mind save 6%, that's where a lot of states are losing revenue. And obviously the box stores, brick and mortar stores are not on a fair playing ground.
The one entity taxpayer that was directly in the bullseye of the states was Amazon. All the states saw all these sales being made through Amazon, and they weren't getting their tax from it. So a lot of the states were trying to pressure Amazon into collecting tax on the state's behalf. Amazon kind of held off on doing that for a while, but for a lot of the states, they finally agreed, and they started collecting tax. So any purchases I make on Amazon, the tax is included as well.
Now, we recommend every business should have a process in place to determine if use tax is due on a purchase invoice. 3 categories that we kind of often see where use tax needs to be accrued. If no sales tax was charged by the vendor. Jason kind of touched on this in a previous slide. If an incorrect rate is charged, whether it's the wrong state or perhaps the particular local tax was not picked up, or just in general, somehow the rate was mixed up on the invoice. And then thirdly, if you ultimately use the product in a different state than the original shipping state. We'll talk about a little bit later that Pennsylvania does not have a temporary storage facility. So if you have something shipped to your warehouse in Pennsylvania, which are ultimately going to ship to New York, you're going to owe Pennsylvania sales tax on that. If you were to ship it to New York, where most areas up there, the combined state and local rate is 8%, you would need to pick up a 2% arbitrage on the rate in New York. So you'd report the full 8%, and then you would take a credit of 6% in New York. And a lot of states have something similar in place for credits for taxes paid to another state in which they are rightfully owed. If they weren't rightfully owed to that other state, then you would owe the full amount. In that example, would be 8% to New York. Now, some businesses in the service industry currently, for example, accountants don't have to charge sales tax on our work. That Jason will tell you. Yeah, that's right now the proposals with the current state proposed budget from the governor. There are quite a few moving pieces, and the service in the sales tax base is going to be brought into a lot of services that weren't previously taxable. But that's another item, and we'll actually be talking about that in July at our next webinar. So I don't want to give too much away, or we won't have much to talk about for that one. But
that and our crystal ball is broken, so we're not quite sure what the actual outcome is going to be.
But as accountants or even other service industries, we may still incur use tax, but most likely do incur use tax, and there are separate form for reporting use tax, whereas if you also collect sales tax, that's reported right on that sales tax return. But if you don't have a sales tax liability ever, there is separate use tax reporting. And a few years ago, individuals now can remit use tax on their PA individual return. I believe that came into place maybe 3 years ago.
That's about right.
Jason, do you know has there been much success with that for the state?
It depends on what you define as success. They've gotten a couple million through self-remittance on that line item, but they were definitely expecting a lot more. I'd say 4 or 5 times that amount that they were expecting to come in through that. I know a lot of people don't even realize that that's there as a line item, or if they do realize it, they just put 0 in and be on their way. So we'll see if that's going to be a collection point in the future for Pennsylvania's Department of Revenue.
We're going to be moving on to audits now, correspondences, various things that the state can reach out to you and then kind of go from there and get back into the best practices discussion. The first type of correspondence that a lot of taxing jurisdictions send out are what is called business activity questionnaires, BAQs for short. We always recommend that accounting personnel who are very familiar with the company's business operations, usually an internal person, would fill these out. We don't like marketing or salespeople filling these out. They tend to, we're doing business all over the place. They like to, somewhat exaggerate maybe how well they're doing it and where they're doing business. We don't like that data. That's good for marketing, bad for filling out BAQs. And then after that, have a third-party professional review it, like us, for instance, or another state and local tax expert. If you're truly doing business in a particular state or city, we see Philadelphia has become very active in sending out BAQs in recent years. It really is what it is, and you might be caught. However, oftentimes what we see are taxpayers fill these out. These BAQs are on purpose very tricky in how they word. They're trying to catch you. It
used to be simple back in the day. They used to be yes/no questions, and you just fill out no the whole way down, and then you were fine. But the states got wise to that, so they switched it up a bit.
Right. So you might be saying you're doing business in a state accidentally and not really realizing what you're answering yes to. So we like to review, and when we see things that would raise red flags in terms of the answers that are given on the BAQ, we like to go back to the client and just clarify with them what they are actually doing. There's been oftentimes where what they said they were doing accidentally on the BAQ is not really what they are doing, and we kind of help them work through it. We've had to, unfortunately, where BAQs have been sent into the jurisdictions before, we've had a chance to look at them. It's much harder for us to go back to the state and say, they really didn't mean that. This is what they meant. And we've had success in doing that, but it's much, much easier to answer properly the first time around.
And we've even not answered a question that's signified with a yes or no response and just said, see attached, and explained our situation. And, if it didn't quite fit exactly what they were asking in the question, we've actually used attachments to provide a little more detail, a little more clarity, as opposed to yes, no, and then, you hit that. If you're truthfully honest, answer yes, and it brings you into the state. But if you had the opportunity to explain the transaction a little bit or the operations a little bit more fully, it would have resolved itself. So we've done that in the past as well.
Exactly. And voluntary use tax compliance notices that were being sent out several years ago by Pennsylvania. I haven't seen many recently on this, and I think the state's kind of gone away from that practice. It's been a couple years since I've seen
any last couple years.
Yeah, I would say in the 2009 through 2013, I saw maybe 40 or 50 of them within our client base sent out. And the answers are usually not applicable. They would look at what the state's doing, and they look at the Department of State listing. There'd be a lot of LLCs and inactive entities, maybe real estate rental partnerships, ones that just don't incur a use tax liability. But it was meant as a double, to raise education or raise revenue, first of all. that was probably their main point, but also to educate taxpayers and allow them to voluntarily remit use tax without getting penalties.
And I think they received a lot of success with regards to the revenues brought in through that. So that kind of dried out. So now that they're starting a new program, I discussed previous, was the business pass-through. The pass-through department unit within the Department of Revenue in Pennsylvania. They are now going through a desk audit program. Still don't have the actual particulars of this program, but from our discussions with the Department of Revenue, what we kind of envision and kind of see coming down the pipe is that they're going to be going out there and looking for taxpayers in which they should be expecting sales and use tax reports coming in, taxpayers that previously remitted sales and use tax reports to Pennsylvania and for some reason or another stopped. Those are going to be two areas that they're going to have right in their crosshairs, and they're going to be checking to see if there's some kind of compliance issue with those taxpayers. They could actually issue jeopardy assessments, kind of just going through the facts and information that they have handy. They can come up with a generic assessment to pretty much get the taxpayers' attention and get them to prepare or submit the required documentation in order for the state to give a better and more true assessment of the sales and use tax liability due. So that's something that we'll be seeing more and more of in the upcoming months. All right, next slide is we're going to go over the procedures with regards to Pennsylvania's audit process. So basically what starts out, before I even get into that, let me just take a step back. I'm not sure if anyone's out there has heard about Pennsylvania joining the Multi-State Tax Commission. They have a joint audit program. They actually have two joint audit programs, one for income tax and one for sales and use tax. For Pennsylvania, they just joined the income tax portion of the joint audit program. So you may be seeing a sales and use tax MTC audit coming your way for other states, but for Pennsylvania, that's not in the cards just yet. I just want to throw that out there to make sure that's kind of a recent update. I believe in November of last year, Pennsylvania signed on. So just want to give you a heads up on that. But for sales and use tax, the notice of audit assessment is sent out through the Department of Revenue. Pretty much random. Although if you've been audited in the past and you owed money, especially significant amounts of money, Pennsylvania or any other state will be calling you again and again and again until you resolve the issues and they're no longer finding the tax liabilities due. So the notice of assessment, you'll see the type of tax, you'll see the tax period in which they're auditing. Word-wise, make sure you understand the statute of limitations for Pennsylvania as well as any other state. You may be asked to extend the statute of limitations for Pennsylvania, especially if one of the audit periods is getting ready to drop off the books. Usually it makes sense, and usually we tell our taxpayers that they should sign off on an extension if it makes sense, because if not, what Pennsylvania and any other state could possibly do is just issue an assessment for that period just to cover themselves. So you don't want them just to kind of throw out a willy-nilly assessment just to make sure that it doesn't drop off the clock. It's much better in most cases to work with the auditor to actually get a good understanding of what is actually due for that time period.
Yeah, and that usually just puts the audit off to a bad start before it even gets started if you're not willing to sign an extension for them.
Yep.
It's better to have the approach of be nice at first and be mean when you have to be.
Yep, exactly. It also includes the name of the auditor. That's one thing we try to reach out as soon as we can and get notice of the auditor. We reach out, introduce ourselves, and try to get things off on the right foot. And then I also try to do a little recon, too. If it's a new auditor that I haven't had the pleasure of dealing with, I try to reach out to my colleagues out there and see if they have had any dealings with these auditors, just try to get an idea as to what we're getting into. I talked about the preliminary call to start the audit. You actually have the commencement meeting. At this, you have discussing the procedures, the information they're looking for, and the timing. Usually, auditors are pretty good to work with regards to timing. If you have an issue where it just doesn't make sense for them to come in that time, they'll work with you and make accommodations that were more suitable to your needs and to your time frame. One of the things that usually is discussed at this point in time is whether you're going to do a full-blown audit where they're going to do a 100% review of everything, or whether what they're going to do is a sample audit. Where they'll do a full-blown audit on your fixed assets, and then they'll take a look at your expense items based upon certain time frames. Usually they'll pick a month Usually it's a 3-year audit, and they'll take a month from each of the years, and they'll do an audit on those expenses and extrapolate it over the audit period. This is a perfect time to make sure you are fully aware and fully prepared for this meeting. You want to make sure that you know which time periods you do not want to be included in the sample audit. If you have an accounts payable individual that's out on leave for an entire month, you want to make sure that that's not included in the sampling audit. Also, if you know of certain items that were purchased that are kind of out of the ordinary, you want to make sure that you're ready. If that is included in one of the sample audit periods, you want to be ready to argue that, to have that pulled out. They will still assess the tax on it, but if you can show that it's truly out of the norm, it won't be included in the sampling. So just make sure you're kind of ready for these discussions at this time. The auditor will request information. You make sure that you give this information to them. Don't give them more than they ask for. Make sure you take a look at what you're giving them. If you have a extemporaneous note written on one of the invoices in which it says something very incriminating, you might want to take a look at that and consider not including that note with the invoice. Then you'll get a proposed audit assessment. This is not the final audit. This is not the final number that's due. It's kind of a point where you can actually have discussions with the auditor. I actually think this is the best time in which to try to save tax dollars and tax liabilities is at this point of the game. If you can get something resolved and taken care of before the audit assessment, I really believe that you save yourself a great deal amount of time, and the great deal amount of time on our end leads to a great deal amount of savings with regards to our fees to our taxpayers or to our clients. So you just want to make sure that you're ready to go through and address any issues. You're not going to agree on everything. Even though I tell my wife all the time I'm right most of the time, the auditors don't buy that. They don't think I'm right all the time, so we never get full agreement. We try to get something squared away and worked out through the audit, but sometimes it's just not going to happen.
Jason, I think you have a better chance of getting the auditor to agree that you're right all the time than your wife.
Mike, you know my wife
my
well.
Opinion.
And then you have a closing audit meeting where you discuss the final assessment and the report. One of the best things to do, especially if it's your first audit, is request penalty abatement. You can get penalty abatement through the audit before it's finalized. So that's something I always suggest you do.
So some key things that the auditor is looking for. Just want to go quickly through these. We talked about vendor charging the wrong state rate. If a Maryland vendor, they might be charging Maryland tax to every customer they have. We see this all the time because they don't want to register in other states, but they feel they're still better off collecting some type of tax, whether it's the wrong state or not. The auditor can usually tell. Now, Maryland has the same rate as PA, so it's not going to be as evident as New Jersey, for instance, which has a 1% higher rate. But they'll often look at the vendor to see if they're registered in PA, and if they're not, they know that they're probably collecting Maryland tax in that example. So they would assess you on a PA tax because it's rightfully a PA sale. Oftentimes they look for no tax on the delivery charge of a taxable item in Pennsylvania. If the item's taxable, the delivery's taxable. A lot of states have different rules, so out-of-state vendors often get that wrong. It's usually smaller amounts because we're just talking delivery, but it can add up fast, especially if he can go through an entire vendor list if he finds which vendors that's a trend for. Inconsistent use tax reporting. We see this a lot with larger businesses. It's hard to catch everything, so they'll catch a few from the same vendor that's not charging tax properly, but they don't get them all, and the auditors usually can pick up on that. They'll compare the use tax reporting support, and they'll compare that, see the vendors that are on there, and see how often they're showing up on the purchase ledger, and they can kind of draw correlations that, hey, it seems like it's a lot more. This vendor's a lot more in that purchase listing than it's on the use tax support. Poorly worded intercompany agreements or invoices. Now, Jason, you review these a lot when we go out.
This is something that's pretty new to the game. Before, pretty much the auditors would go by what was written on the invoice, anymore they're taking a look at it, and there's, especially when it's intercompany, they want to make sure that they truly know what the transaction is. So they start digging into these intercompany agreements. And if you have some key words in that agreement, it could trigger a potential tax liability. So that's one thing. I always try to find out, do you have intercompany agreements? If you do, let me take a look at it. Make sure that there's no words that will trip you up. The same goes for an invoice. If you just say professional services for Pennsylvania, as of now, their professional services are not subject to sales and use tax. But if they kind of go in and say, well, what are these professional services? Let's take a look at the actual agreement. And they start pulling out some potential areas, debt collection services, if that's included under the term professional services, then Pennsylvania could have a position to say, hey, some of these are taxable services and we're going to assess you on it.
Another thing is unsupported positions by the taxpayer. I see this a lot with electricity studies, sometimes forklift studies as well. In Pennsylvania, commercial electricity is subject to tax, but a manufacturer that obviously would be using electricity in its operations directly and predominantly could be exempt on that purchase of electricity, that portion of it. So let's say, for instance, a manufacturer is saying 80% is exempt. Pennsylvania could buy off on that, but the technical requirement is that a third-party study needs to be performed. What we think is, if PA usually does when they do buy off on it, maybe you're not getting the highest percentage you could.
Oh, you're saying when Pennsylvania buys off on not having a study,
yes,
they see we'll give you 80%, but you might be worth 90% of the exemption.
Exactly.
Yep.
Exactly. Missing or incorrect exemption certificates. This has been a big issue with auditors past year or two, and the Department of Revenue is really taking some aggressive positions on this. Unit certificates. If you're getting those from your clients, or your customers, the difference between a unit and a blanket exemption certificate. A unit obviously is for a single purchase. A blanket might be a manufacturer's purchasing all exempt items, and they're purchasing similar ones. So instead of giving a unit exemption each time, they give the vendor a blanket one. So don't get those mixed up. Don't be accepting a unit certificate and then making all sales to that customer as exempt.
Usually Pennsylvania will give you a chance to perfect those exemption certificates, but you can get an auditor that's taken a hardline stance and said, you made this purchase with an invalid exemption certificate, I'm assessing the tax. So just kind of keep up to date on your exemption certificates.
This one's been a real sticking point for us. It's exemptions that the auditor determines the vendor should know weren't applicable to the purchaser. And the rule of thumb is that if you accepted an exemption certificate in the past in good faith, you're good. Unless it was very obvious, like some guy coming in buying TVs with a nonprofit exemption certificate
being delivered to his home,
to his personal home, or that's not really good faith. But we've seen the Department of Revenue, particularly in Pennsylvania, take the position for instance, building machinery and equipment that's being sold to contractors that are performing jobs for nonprofits. The vendor doesn't charge them tax because the contractor is giving them a correctly worded exemption certificate, and the particular item is gray on whether it could qualify. The Department of Revenue is taking the position that the vendor is liable, even though they accepted what they would consider and what we would consider a good faith argument. And that's one that we've had to take to appeals, and the auditors, like I said, have been very aggressive with that. And the primary thing, and I left it for the end to emphasize it, if there's a deficiency from a prior audit, make sure you take care of all those deficiencies. That's the very first thing that the auditor is going to look at when they come back again.
Plus, if you don't take care of it, it's an uphill battle trying to get penalty abatement.
Exactly.
All right, up next is procedures and what to do during the audit. I'm going to try to get through this pretty quickly. We have a lot more to cover, and up next is if you're handling the audit yourself, that's great, but we'd always recommend using a third-party representative. It'd be great if it was us, but no matter who you use, I always suggest using a third-party representative just because you don't have the interaction with the auditor. The taxpayer and the auditor don't have a confrontational relationship. The auditor works through the representative. The representative works with the taxpayer to get all the information in order. If there's a gray area in which the auditor is trying to get some information, we can make sure we craft it in a correct way, but make sure it's in the best light possible and for our taxpayer.
One advantage of having a third party handle the audit is that we can say, I don't know.
Yeah.
It's harder for the actual business person to say, I don't know, because they should know usually.
Yeah, it's
and
your business.
That buys us some time. We can say, I don't know. It's not strange or fishy, and we can usually come back with a better comeback then instead of trying to think of something on the spot.
Yep, definitely. One thing we always joke about is make sure the auditor is comfortable, but not too comfortable. Don't put them down in the basement on a 120-degree day where they're sweating nonstop with no access to water. But also don't put them in your boardroom where they have access to televisions and they can kick back and relax in the air conditioning. There's a happy medium somewhere. That happy medium should not include anywhere near the restrooms or water fountains or anywhere where people congregate for the taxpayer.
Or very talkative employees in their cubicles.
Exactly. You want to keep them away from that because you don't want to give the auditor any additional ideas or thoughts in which they weren't going down that road. So one way to do that is kind of keep them alone, put them off in the corner somewhere, give them a desk, give them some electricity, and let them be. We'll discuss this later, but through the audit process, make sure you're searching for potential credit refund items that you can use to offset the assessment. Carefully review preliminary assessments. Make there's no mathematical errors. Make sure that items were shipped to out of state. If Pennsylvania is trying to assess it, make sure that it was actually shipped to and used in PA. And if they need, provide any additional clarification or evidence. And like I said before, always request penalty abatement. Worst they can do is say no. Next up, going to run through what the procedures are after the audit. Pennsylvania's administrative procedures. Mike and myself can represent taxpayers in the first two phases. After that, we kind of have to take a step back and hand it over to the attorneys. So the first phase is the Board of Appeals. We've had great success with the Board of Appeals on various issues, but a lot of people look at the Board of Appeals as a black and white. Is it a slam dunk? If it's a slam dunk argument, if it's an obvious error, you can get relief at the Board of Appeals. We've actually gotten some rather, decent results at the Board of Appeals, and I enjoy working with them. Board of Appeals, you can actually enter into compromise offers. They can be accepted here at the Board of Appeal level. It's an informal hearing with the hearing officer. Once you make your presentation, they take it back to the board and they make a decision. Once that decision comes down, your next step is the Board of Finance and Revenue. The Board of Finance and Revenue has made significant changes over the last year. It was more of a informal hearing in the past before a board of 6. Now it's more of a controversial meeting with Department of Revenue there presenting their side and the representative or taxpayer presenting their side. If anyone has questions about the Board of Finance and Revenue, I could probably do a 45, 50-minute webinar on that alone. So feel free to reach out to me. That's where you get a lot more results with regards to the gray areas. If you think you had a great argument with Board of Appeals, you don't get the relief there. We normally find that the Board of Finance and Revenue, they'll have a little more leeway with regards to giving you relief on an issue that you think is a slam dunk. Once you get, another thing, you can actually go through the compromise as well through the Board of Finance and Revenue. And then after that decision's passed, we kind of take a back seat, and that's when we help our clients get representation through Commonwealth Court. Most of the time at Commonwealth Court, at the end of the day, you're going to be coming up with a compromise. Over 95% of the cases that go up to Commonwealth Court are ultimately compromised. They're not going to actually go through the whole trial process you see on television or in the movies. It's behind the scenes making a deal with the Department of Revenue and the attorneys at Commonwealth Court.
We're going to shift back to some best practices, talk about being proactive, and we're going to start racing through with some of these. We're losing time, so we're going to go a little quickly on them. Sales and use tax, as you can kind of see from our presentation so far, is quite a gray area. If you have three different people looking at a transaction, you might get three different outcomes in terms of the taxability. That's why it's good to be proactive on the gray areas. The first area we'll talk about is in obtaining some clarity for uncertain areas is obtaining a Department of Revenue private letter ruling. This is where, for free, this is unlike an IRS one. A lot of people shy away from private letter rulings because IRS ones can be very pricey. Pennsylvania does do free ones through their Department of Revenue's Office of General Counsel. If a taxpayer discloses all the facts and circumstances and also taxpayer identification and asks for determination on a particular transaction, they will get a ruling from the Department of Revenue, which they could use and is valid for 5 years, both in audit and any other scenario, only specific for that taxpayer, and then they would have to renew that every 5 years. This is, of course, contingent on all the relevant facts being disclosed. I think really using a third party to assist with this is important because from a sales and use tax perspective, the practitioner will have a better idea of what questions we would think the general counsel would find relevant to the scenario. Also, the taxpayer may prefer a certain outcome. So truthfully and providing carefully wording the request might have a better chance of getting the outcome that the taxpayer is actually seeking. I'm just skipping down one to documenting a statement of position. There may be many scenarios that the taxpayer doesn't want to necessarily disclose to the Department of Revenue. It might be a transaction that it's gray and they're afraid of what the answer could be from the Department of Revenue. This is where it's still good to be proactive. Take a statement of position or have a third party opinion letter prepared in case an audit were to come about. This could be something provided to the auditor right off the bat as a statement of position, but not something you would necessarily want to draw to the attention of Department of Revenue for no reason. And consulting third-party opinions, there's many times where a situation isn't material enough to go through a process of preparing a statement of position or obtaining a Department of Revenue letter ruling. Consulting with third-party professionals, getting a brief email just to get a different perspective is key, and we do that often for our clients. I think the second area is if we, as I look at the bullet points there, exemption certificates. Just ensure that there's a good procedure in place for maintaining the exemption certificates and keeping them on file and being able to actually provide an auditor upon request. This particular exemption certificate went with this particular sales invoice. It doesn't have to be right behind it. That's a good procedure though to do. But there should be some type of tracking information on that invoice that there's not sales tax being charged. That can go back to a specific exemption certificate on file that can be provided to an auditor. And we suggest updating blanket certificates every 3 to 4 years because sometimes a taxpayer situation might change or your customer situation might change and they might not have notified you of it. Oftentimes when they're getting no sales tax charged, they might be purposely that they're not notifying you, but most of the time it's just accidentally. It's not something they would have thought of or even looked at. So getting those every 3 to 4 years will definitely help.
So up next is some additional best practices. When you're doing business in other states, especially just occasionally going in and outside the states, you want to make sure you consider whether you've tripped the nexus or filing requirements in that state. If you've determined that through your activities in the state, nexus has been created, you want to take a look into programs that state might offer, such as voluntary disclosure programs or tax amnesty program. We always recommend using a third party to enter into these agreements because you want to make sure you remain anonymous in the state's eyes. And if they have caller ID and you call them from your office, it kind of destroys the anonymity. And and we talked about this before, if one of your customers says that they are going through an audit and they're going through an audit and the state's assessing them based upon the sales to you, and they want you to, give them payment. Just don't send them a check. Get some input from a professional as to whether that seems reasonable, whether we're taking a position that is not taxable. Maybe we're already assessed tax on it, and you can collaborate with that taxpayer and say, hey, Pennsylvania, you already got the tax once, you can't get it twice. So I'd always say, reach out and get some input with regards to this. And one thing that we always like when we're kind of reviewing purchases is making sure that it is abundantly clear on an invoice whether use tax has been charged, whether it be a signature, a little note, a stamp. Showing that use tax was assessed and remitted to Pennsylvania or any other state goes a long way to making your audit less painful. If an auditor is looking through all these and it's not easy for them to identify that use tax was charged, they're going to assume it wasn't, and they're going to assess the item, and then you have to fight to get that off the assessed. All right, up next is we have some opportunities to save here in Pennsylvania. So we're going to go over briefly some key exemptions and exclusions. The first and foremost is manufacturing and processing. One thing I always tell clients, they think, hey, I'm not a manufacturer. Well, let us take a look as to what you're doing and see if, hey, maybe you could potentially be deemed to be a manufacturer here in Pennsylvania. Pennsylvania likes to take a view of things as black and white. Like Mike said earlier, we live in a world of gray. So there's a potential that even if you don't think you're manufacturing and you're doing some kind of process, there's a possibility that we can make an argument that you are a manufacturer. Trucking operations, common carrier exemptions here in Pennsylvania, construction contracts. This is a big issue that people go through. At the end of the day, the construction contractor is deemed to be the end user and is subject to tax. So if you're involved in a construction contract and they're charging you tax in addition to the contract amount, that's an item that you can get some relief on. Also, building machinery and equipment with regards to exempt orgs. That exemption in some circumstances can pass through to the construction contractor, and they can make your purchases for that contract exempt from tax. If you're purchasing custom software, computer services, those are exempt here in Pennsylvania. You just want to make sure that it's not canned software. You gotta really, it's tough to make the argument that it's custom software. It has to be abundantly clear that this was made specifically for you. Cloud computing, computer services used outside Pennsylvania. There's a nice private letter rolling out there that we've been able to get some relief for taxpayers that are using computer services, not just here in Pennsylvania, but in all the other states as well. Professional services, landscaping, snow removal are some items that we're consistently seeing tax being charged on that we're getting relief at the Board of Appeals, Board of Finance and Revenue.
And continuing that, employee cost of help supply, which is basically temporary labor and building cleaning services, the employee cost is actually exempt. So, for instance, if a vendor is upcharging their services by, for instance, 20% just to cover overhead and administrative functions, only 20% of that contract is taxable. Oftentimes, what we see is vendors might even know that, but they purposely do not break that out on the invoice. They don't want to give their customer an idea of how much they are marking up their services by. But that's just throwing away sales tax that your company is paying for really no reason. Most purchases made by nonprofits and governments are exempt. Special resale, this is where a vendor would purchase something, a customer would purchase something and the item would be shipped to Pennsylvania. As we talked about before, there's not a temporary storage exemption in Pennsylvania, so Pennsylvania sales tax would normally be due. But if the purchaser fabricates it into another product and then ships it back out to a division in another state, for instance, that's considered a special resale, even though, and it's the reason special resale in quotation marks is it's not really a sale that's occurring, but essentially it's not really being used in PA, it's being incorporated into something else and being used truly as a finished product in another state, and that would be an exemption. Bulk sales, if there's 51% or more of a sale of a business, the assets involved in that transaction would be exempt. And then
One thing
lastly,
that
bad
kind
debt
of
expense.
falls into bulk sale that I
sorry.
find is occasional sales too. If you're
Yeah,
making
exactly.
a one-time sale at a yard sale, that's not subject to tax. So
Right. Bad debt expense. This is a really tough one to get back in Pennsylvania. Unlike some states where they allow you to take it as a credit on a future return, you actually have to go through the full formal appeal process with bad debts, and it's the statute of limitations in terms of being able to go back and get that refund are pretty stringent for that type of transaction. And really, what's going on there is if you collect or if you make a sale, customer terms you don't have to pay, or they don't have to pay for 30 to 60 days. As the vendor, you're required to remit that sales tax to the state. So you've already remitted it. If you never collect on that sale, you basically paid sales tax to Pennsylvania for a transaction that never really ended up occurring, or you never received any revenue for that. So that's when we talk about a refund. That's the sales tax that was paid. Now, kind of lastly, we're going to get into what does a sales tax review consist of. And also, we're going to talk about why you really don't have to go into this process alone and kind of...
It can be a lonely world in sales and use tax. You don't have to be alone.
Exactly right. We should have some theme music going on here.
So basically what we're talking about here is sales and use tax. We said it, I must have said it a dozen times already, but it's a world of gray. If you're not dealing in this spectrum all the time, it's very easy to get tripped up on things. Mike and myself, we're going to Board of Appeal hearings, Board of Finance and Revenue hearings. We're meeting with the Department of Revenue, having discussions on issues. We're even going out with our colleagues for lunch and discussing these issues. We kind of have a warped sense of fun. So I think we kind of run in packs, but we're always discussing the current trends that we're seeing, what other taxpayers, what other representatives are seeing out there. So if you're really not dealing with this all the time, you can really get tripped up pretty quickly. Another thing is sales and use tax laws are constantly changing. It's not even just the constantly changing laws, it's the constantly changing positions that Pennsylvania or any other state out there may be taking. Next bullet point is perfect. It's a fresh set of eyes. You know, if you keep doing the same, accounts payable, you're going through your accounts payable, and for the past 3 years you always see tax coming from this vendor, you're not going to question it. But if we come in, maybe we ask you a question or raise an issue that you never thought about that could potentially create some tax savings. We're always there as a resource for our clients to bounce questions off, to bounce issues off. We had one client recently ask if, I want to do a private letter rolling. I'm like, well, that's fine. We can help you with that. But did you think it through? What if you get the reply that you don't want to get back from Pennsylvania? Is the private letter rolling the way to go, or does it make more sense to say, hey, look, here's our position, here's how we're treating these transactions, and explain it that way in case an auditor ever comes in?
And one of the things I've found very beneficial in our practice is it's not what you know, it's who you know. And Jason, you have a lot of key clients at particularly Pennsylvania, but a number of other states in this region that have really helped us over the years.
Definitely. I've been very fortunate to work with some great individuals throughout my career. A lot of the individuals now are high positions over the Department of Revenue, and I keep in touch with them. And they've been a wealth of knowledge, and they've been very helpful in helping us resolve issues with our taxpayers. And I couldn't be more thankful for that relationship with them.
And along those lines of not doing this alone, we really recommend to a lot of our clients or potential prospects or ones that aren't even have any affiliations with our firm that we perform a sales and use tax review for them to kind of look at their records. It's a very non-committal process for the taxpayer. There's no cost to it. It's free. And secondly, it really doesn't take much of their time. Jason and I would basically come out, review sampling of purchase invoices, usually look at a year's worth of those purchase invoices, review some contracts, take a look at the intercompany agreements, and also read if there was any prior audit narratives. And we'd also then have a meeting too with management, maybe a half hour, to discuss their business operations, which give us a better understanding of what the taxpayer client is involved with and how we can assist them on the review side. and also possibly take a tour. That's probably our favorite part of the job with manufacturers or processors. We've had some good ones, like bread manufacturers. We've had some ones that were waste refineries, so that wasn't as much fun. Although it was much cleaner than we thought it was. But we would identify not only refund potential, but also identify some key exposure items and kind of prepare some talking points and provide that to you. Again, all of this is free of charge, and we make some recommendations based on our findings of that preliminary review. So we always really think there's some value in these reviews, even if there doesn't seem to be a refund potential retroactively and going to the board. There's obviously going to be some perspective opportunities, and
we've actually, through these reviews, ended up, if there wasn't a refund opportunity, we've actually got engaged to do some process reviews, take a look at how the process of sales and use tax is currently being done. How can we assist in making it a little better? Can we assist in making it a little cleaner? So it's always best when we can, at the end of the day, provide a check to our client in the form of a refund. But even if we can't, there is some value that we can add to help you run your business from a sales and use tax perspective more efficiently. Finally, is you'll see our diagram. The one thing that we kind of pride ourselves at McKonly Asbury, our state and local tax practice, is that we're not just going out there kind of viewing this any refund opportunity as an annuity. We're kind of viewing it as a combined effort to make sure that your sales and use tax processes are running effectively, efficiently. Make sure that anything that we get through a refund, we resolve that issue. We help clients make sure that going forward, anything that we get refunds for, we try to make sure that they correct the issue so they don't have to pay the tax going forward. That's a huge item that a lot of service providers don't do. They kind of take a look, they get the refund check, they take their cut of it, and then they proceed and wait a couple years, and then they do the whole process again. What we're trying to do is fix the main issue through a sales and use tax review. We want to help you, help yourself with regards to making sure that you stay off Pennsylvania's radar or any other state's radar. So that's kind of where we stand. We really appreciate your spending time with us this afternoon, and we will address a couple questions after this brief word from Tyler. Thanks.
Thank you once again for joining us for this presentation, produced by McKonly Asbury. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us at www.macpas.com. Thanks again, and have a great day.